Our dearest audience, welcome to this episode of the Markets Talk Show, brought to you by Bahrain Bourse. I'm Noorhan Al-Zan, your host, and in this show, we interview top market experts to discuss capital markets and help you make better informed saving and investment decisions. In this episode, we're going to be discussing the GCC and the MENA markets, understanding the factors that affect their performance and influence us as retail savers and investors. In this episode, we're pleased to be joined by Mr. Tarek Fadlallah, Managing Director and CEO of Nomura Asset Management, Middle East. Tarek has over 35 years of experience in capital markets, and 25 of which are focused on the Middle East region. Tarek is a member of the Economics and Energy Program in the Middle East Institute, Washington, D.C., and is a regular guest analyst on Bloomberg TV and CNBC. Tarek, it's lovely to have you with us in the show today. Thank you for joining us.
Thank you for inviting me.
Tarek, we want to dive straight into the GCC markets. And in 2024, the Tadawul All-Share Exchange and the Bahrain Bourse All-Share Exchange have shown flat to moderate performance. If you can share your insights on the performance in 2024, and if there were any large movers or anything that was of particular interest.
Well, first of all, as you say, 2024 has been a moderate year for stock exchanges generally in the region. But we need to be careful about looking at calendar years when we're assessing performance of markets, especially if you're an investor and a long-term investor. So if you look back 1 year rather than just the calendar year, you find that actually the Tadawul was up double digits, around 10%. And that's because the last quarter of last year was a very strong quarter. So as I said, don't just focus on a calendar year, but look at the markets in the context of where they have been, where they've come from, and of course, where they're likely to go.
Okay, so with that in mind, when I'm looking to invest in the GCC markets, how do they compare to global markets when it comes to volatility and general performance?
Well, over the last 5 years, the standout market globally has been the US market. And so it's natural that the GCC markets have not performed as well as the US market. But actually, if you look beyond the US market, there have not been very many markets that have done as well as the GCC. So for example, over the last 5 years, the GCC has outperformed the MSCI Emerging Markets Index, and it has also outperformed the MSCI Europe Index. So investors in the GCC have performed relatively better than these two areas.
And Tarek, we understand now that there are interest rate cuts in the market all over the globe, obviously, and also in the GCC. So if I'm an investor in the GCC, how would I expect those interest rate cuts to affect my equity holdings and additionally the interest rate movements as well?
Yes, so I mean, that's a very important point because interest rates have been elevated for the last couple of years, but it looks as though inflation is starting to come down to a reasonable level, which will allow the central banks around the world to cut interest rates. And the most important central bank for this region is in fact the Federal Reserve of the US due to the currency peg. And we have a clear idea now that the central bank of the US, the Federal Reserve, will cut interest rates by around 100 to 150 basis points. So that's up to 1.5% over the next 12 months. And that will feed through directly to lower interest rates in this region. And there's two impacts of that. The first impact is the impact on the economy. Lower interest rates usually leads to stronger economies. And the second point is that lower interest rates make risk assets more attractive. And so that should lead equity markets to move higher.
Oh, that's wonderful. So it's, if I understood what you said correctly, it's good news for our equity holdings.
Absolutely, it's good news.
Fantastic. Now, if I'm an early stage investor listening to you at home and I wanted to go in and start adding equities to my portfolio, what would be important pieces of data or information that I should be looking at before I start investing?
Well, I think one of the issues these days is that there is a lot of information available to investors. Maybe too much, if I'm honest, because sometimes it causes more confusion than clarity. The first thing to do is to take a step back and to think about what it is that you're trying to achieve by investing. So the first decision is, do I need to be in the market? The second is, what should I be investing in? What asset classes are the asset classes that I need to get exposure to? And the third part is, how do I get exposures? Which securities or which funds do I buy in order to get that exposure?
So I see you alluding a lot to what asset classes. Does that take us to a question around asset allocation, and how would that be different per investor?
Sure. So every investor is different. Some investors will be young, some will be old, some will be having several incomes, some will be working 9 to 5 very hard for a single income. So I think the first thing to say is that your investment plan should depend on your personal circumstances, and your asset class determination will be part of that process. So you'll need to think about what it is that I'm trying to achieve and how much risk do I need to be taking.
Is it also valuable to think of how long I have in terms of my investment horizon, like how long I have for my investment?
Absolutely. So again, if you're a young person in your 20s, you have a very long time horizon before your retirement date. And so you're willing to take greater risk than somebody who's perhaps approaching retirement age and is looking for income rather than capital gains.
Fair. Okay, and if we get this question a lot, if I'm a retail investor and I want to come in, how much money do I need to be able to enter into the stock market? Because there is an assumption to say that I'm going to need a large sum of money to be able to invest like professionals.
No, not at all. In fact, investing has never been as easy as it is today. So as you know, there are major financial institutions that have got platforms, electronic platforms, where you can put in very small amounts, hundreds of BD, maybe even less than that. So you can, if you could do it on a monthly basis, you can put in 10, 50, 100 BD a month and save your way to eventually what's going to hopefully be a much bigger pot.
Okay, so we're saying that technology is working in our favor with this, when we could just do this through an app. Correct. And primarily be able as well to track it.
Correct, absolutely. So the apps these days are absolutely wonderful. The danger, of course, is that you get addicted to these apps and you start over trading or trying to do too much too quickly. Saving is really about patience and about being thoughtful and really trying to stick to your objectives and not to get too clever around how you achieve those.
Okay, so if I just picked up correctly, if I'm going to invest based on what you recommended, I can start with small amounts, but that consistency that you mentioned is going to be important for my portfolio? Absolutely.
So look, saving is important discipline. The earlier you start, the better it's going to be, because that will allow the money that you invest early on to compound through the returns that you're generating over many, many years. And so to your point, yes, absolutely.
Okay, so a lot of the younger investors perhaps are always talking about market timing. And I know that is something that professionals like you can share insights on. Is it possible to time the market, or is there a smarter way to work around that?
I've been in the market for a very, very long time. It is impossible to time the market. So again, going back to this discipline, if you can be disciplined about investing on a regular basis, you will buy stocks expensive perhaps, but you'll also buy them cheap. And what you will achieve over a period of time is what we call dollar cost averaging, which gives you a good average price into the markets.
So dollar cost averaging together with the compounding should be what the young investors or the retail investor should be thinking about, rather than timing the market and
Absolutely.
When to enter.
Absolutely, correct.
Stunning. We've covered equity, so I want to take you over to the debt markets. And in the GCC, we've had a range of issuances, from sovereign on treasury bills and bonds, and additionally in corporate issuances as well. So if I'm looking at the fixed income as an asset class in the GCC and MENA, what does 2025 look like given the market performance?
So the starting point is that interest rates, or yields as we call them on fixed income securities and sukuks, are relatively high at the moment. So the US Treasury 10-year bond, which is a benchmark for where other bonds are trading, are currently yielding around 4.25%. And that's not bad. Remember, not very long ago, interest rates were zero or very close to zero. So the starting point is relatively good yields, good returns. And as interest rates go down, that should make those yields even more attractive. So this is not a bad point to be looking at investing in the fixed income markets.
Okay, so we're still finding that fixed income can be a returning in terms of returns as a market to look into 2025.
Yes, look, you're not going to get double-digit gains in the fixed income market, but that's not what the fixed income market is for. It's for steady, reliable returns over the long term.
Great. So we're listening to you and saying that equity is probably going to offer higher returns in 2025, but fixed income is also another asset class that if I was looking to adjust my asset allocation between bonds and equity, that would give me also a nice mix if that was something I wanted in my portfolio.
Correct. It's called a blended yield or blended return, as we say.
Blended return. Great. Now, we've received a lot of questions from our episode 1 with a lot of the local investors asking about Sharia compliant offerings. And we understand that that's readily available all over the GCC in Bahrain, but we wanted to understand from you, what is the difference between a Sharia compliant debt issuance and a conventional or non-Sharia compliant?
So in terms of returns, typically not very much. The basic difference is in the way that the instrument, the security, is structured. So a Sharia sukuk would be structured around, in accordance rather, I should say, with Islamic principles around collateral and profit sharing. The real issue when you're looking at a treasury bill or a sukuk is who is the issuer and how much are they looking to issue for. Don't forget that when you're investing in these products, you're effectively lending to the issuer, so you have to do some homework around who you're lending to and for how long you're lending to them.
So it's kind of like if I was lending someone money and I just wanted to make sure that they can pay back my money. Is that the same concept?
That's exactly the concept. So, instead of the banks lending to these companies, it is you as the investor who is lending to these companies.
Fair. Now, if I was listening to you and I wanted to add those kind of investments to my portfolio, where can I buy them? Or also what sort of data should I be looking at?
So buying fixed income securities is relatively easy. Lots of fixed income securities are listed on stock exchanges, including here in the Bahrain Stock Exchange. I think the difficulty is that you don't necessarily want to take a risk on a single name, especially when you don't have a very large amount to invest. So it's probably better to go through a fund, but you just need to be a little bit careful because some of the funds are quite expensive. So always look at what's called the TER, the total expense ratio, and that will make sure that you're not overpaying for some of these products.
So if I looked at the TER, what number should I have in mind to know if I'm overpaying or underpaying?
Well, for a fixed income fund, you don't want to be paying more than 1% and preferably less than that.
Okay, so if I'm going down the fund route, I have to look at a TER that is less than 1% to know that I'm being...
For a fixed income.
For a fixed income fund,
correct.
Just to know that I'm not overpaying when it comes to the fees.
Correct.
Fair. Okay, now this is a question that we think is very important. If I want to start investing and I think fixed income is an option, but equity is an option, what's a good portfolio allocation? So that little mix that I'm going to create, how do I know how to split between my fixed income and my equity?
That's a very good question, and most people don't know where to start and what the benchmark is. But actually, in classic literature, historically speaking, you've had a portfolio that would be 60% equities and 40% fixed income. But again, it depends on how old you are. If you're in your 20s and you have the ability to wait out the volatility over a long period of time, you can be up to 80% equities and 20% fixed income. Whereas, of course, if you're 50 years old or 60 years old, you don't want to be taking that type of risk. And you want to be perhaps only 20% equities and 80% fixed income. But the complication is that today, we have a number of new asset classes that you can add to the mix to give yourself a better diversified portfolio. And that includes things like private credit, private equity, and also, of course, crypto assets, which have become very popular in recent years.
Tarek, if we can shift to the real estate as an asset class, and it has always been an area of interest in the GCC. If you could share with us, what is the expected performance in the real estate as an asset class in 2025?
the performance of real estate in the last few years in the region has been very, very strong, and not just in Dubai, which gets all the headlines, but actually across the region. Real estate is a long-term investment. Historically, it has done very well. There has been, of course, volatility, including in places like the UAE, but over the long term, it's an asset class that most investors should have.
Tarek, if I'm one of those investors who wants to add real estate to my portfolio, but I can't afford to pay a down payment or perhaps to buy a house or an apartment outright, are there any investor-friendly options that I can look into?
Yes, there is indeed. So real estate investment trusts, what we call REITs, are listed on most stock exchanges in the region, including, of course, here in Bahrain. And these are vehicles that contain a number of properties that are managed by a professional manager, and they pay out the income generated by these properties in the form of a dividend, which is paid out to shareholders.
Okay, so just to understand, is real estate like a real estate investment trust like a fund similar to the exchange traded funds?
Yes, exactly. So I think that's a very good comparison. So effectively you're buying a fund, but this is listed on the exchange. You can buy and sell it on a daily basis. They typically have quite good visibility in terms of their reporting requirements and the need to pay a dividend on an annual basis.
Okay, and are there any other options that I can consider if real estate is outright real estate or REITs, or any other options that you would recommend?
Well, there's something that's starting to become very popular, especially amongst the younger investor, and that's called PropTech, property technology. And that allows you, through widely available apps, to buy small percentages in properties using what they call fractional investing. So fractional investing basically means you're buying a fraction of a property, and some of these apps are allowing you to buy for as little as 10 dinars. A stake in a real estate property.
So to understand that, does it work similar to like crowdfunding, when we're all coming together to fund a particular project and then we're all getting paid out simultaneously?
That's a good example, yes. So basically you, me, and a bunch of other people club our money together and we buy a property, and then we can trade it to each other or to other investors in the marketplace.
I'm picking up in today's episode a lot of things from you, but the most dominant thing is that there is plenty of opportunities for us in the region to look into and to invest if we were just able to identify where we want to start. And so I want to really thank you for that. We're nearing the end of our episode today, and I always like to end with the personal recommendations of our expert speakers. So I want you to help me go through a step-by-step guide. If I wanted to start investing, I was going to end the show and start investing, walk me through a step-by-step guide of what I should do based on your recommendations.
Well, I think the first thing is to establish why it is that you want to invest. Is it for a long-term savings plan? And if so, then you should decide on the asset allocation that you intend to invest in. So typically that would include equities, that would include bonds, it may include real estate, private equity, cryptocurrencies, for example, could be a small element of that. So I think the first thing is to establish what it is that you want to achieve, and then step two would be to see how you can gain exposure to these specific asset classes. So if you wanted to invest in equities, do you only want to invest in Bahraini equities, or would you like to have some international equities? How much would you like to put in international equities and how much in GCC equities? Then you do the same across the other asset classes. So for fixed income, do I want to invest only in Bahraini fixed income, or should I perhaps diversify by buying some international fixed income as well? So it sounds complicated, but it's actually not that difficult if you think about it from a savings perspective and a way to preserve your wealth and to increase over time.
So Tarek, thank you so much for that. So I'm going to sound it back to you and see if that makes sense, let's say. So first of all, I'm going to decide on my purpose of investing. So like we always say, maybe we're investing for the long-term savings and investment. So I'm after the long term. The second thing, we'll see how much money from my current earnings that I can set aside. So let's say I'm able to put about 10%. That would be the second decision I can make. The third decision I can make is decide which markets I want to be invested in. And the fourth would be which asset classes, equities, debt, real estate, all the stuff that we discussed today. And then what should I do?
So the first thing is to go and speak to your bank because banks typically these days have got platforms that make it relatively easy for you to invest. And through the platform, you will be able to access directly the stock exchange in most cases. So you'll have access immediately to the local stock exchanges. And most banks also will have a list of funds that they offer you across all of these asset classes. So you can look at what's available, you can shop around a little bit maybe, and then you can decide what you want.
So going to a bank or perhaps even a broker that would have access to those markets could help me. So I've established the first set, I found a broker, and then I was able to get my money put into that account. Then what can I do?
Well, then it's a question, as we discussed, of deciding in each asset class, how much do I want to put in? And look, just to be clear, all of this should be done at the beginning. You're not having to do this every month. You set the objectives at the beginning, and then it becomes almost like an automated process. So as you say, 10% is a very good number to start with in terms of how much to save of your monthly income. It will vary. There are some people for whom 10% is too much. Some people who can afford to set aside 15 or 20%. It depends very much on personal circumstances. I appreciate that. But once you decide how much you want to put in, you set the asset allocation parameters, and then you just go on investing month by month on those broad parameters.
So once I set up the portfolio and I put in my allocations, then I just keep adding onto it so I can benefit from the compounding and the dollar cost average that you referred to at the start.
Correct. So I think this is the advantage of having a discipline of saving early and saving regularly and saving with an objective in mind.
Finally, Tarek, when I have experts, speakers like you with me on the show, I always like to ask for your own personal recommendations. So how does an expert like you, or what does an expert like you think about before they're making their own investments and putting their own money into an investment?
So I think I tried throughout my career to balance my short-term liquidity needs with the requirement to save for my retirement. And I've done that by being relatively cautious and holding a diversified portfolio that has included equities as well as fixed income and real estate. And I think that having this kind of approach may not be spectacular in terms of returns, but steady, because steady at the end of the day usually wins. I think the danger is when people get excited or overly excited about a single asset class because they've heard that somebody has done very well by buying, for example, Nvidia shares or by buying a single property in a certain jurisdiction. Those stories sound great in hindsight, but they're very difficult to predict initially. So I think the way to avoid that is to remain vigilant, do your due diligence, do your homework, and stay diversified.
Wonderful. Tarek, it's been an absolute pleasure to have you with us today. We've learned so much, and genuinely, thank you for sharing all your expertise with us today.
It's my pleasure. Thank you so much.
Our dearest audience, thank you for tuning in to this episode of the Markets Talk Show. We hope that you found this episode informative and engaging. For now, stay informed, stay invested. We'll see you next time.